Welcome back. This is our next episode of Chart Overload. It is August 2025. We are Sollinda Capital Management. I'm Ryan Mumy, the CIO, or the CEO. And this is my partner, Justin Greenhill, our Chief Investment Officer. And today we're going to go through a lot of charts and we're going to talk about them. I always say it's too many, and Justin says it's just the right amount. So we appreciate you joining us today. We'll go ahead and get started. First, big picture, Justin, this first one, looking at the tariff ranges going back to Liberation Day for most of our big trading partners. And as we've shared in past videos and commentary, they've been all over the place.
Yep. Good day. Good day. Thank you, everyone, for joining. This chart, just to kick things off, is pretty representative of kind of where we've been with tariffs. Black dot, where they were initially announced, the now infamous imports minus exports divided by 2. And the blue dot is where they landed as of the end of this week, or the end of the month of July, I should say. So as you can see, Vietnam, South Korea, Japan, and Europe notably lower than initially announced. And then there's some other smaller trading partners that are more or less in line. And the big question remains, what does the rate settle at with China?
Yeah, Canada, Mexico, also important, but China's the big one. Moving on to our next big picture chart is U.S. government debt continues to trend upwards as far as amount of total debt.
Up and to the right, yep. And
how we wish all our investment charts look.
Yeah, if you can buy and hold the government debt, then you're in good shape. What's interesting about this is not only the fact is it moving upward, but as you can see, more recent years, the slope upward has increased quite a bit. So, and this is not purely a U.S. Phenomenon. This is true around the world. The U.S. just obviously catches attention in that the economy is so large. So when you say government debt is above 100% of GDP, that's a very big GDP number.
Yeah, but to your point, you stole my thunder. That's what I was going to say, is this isn't just a U.S. thing. All countries, all major developed countries for the most part have moved in this direction really since the financial crisis, and then also COVID. But it's something to pay attention to because, at some point it has to come down, or GDP has to be increased so it's, more salvageable. It isn't such a large piece of the annual federal budget. Moving on, again, just what we talked about as a percentage of federal budget. What are those interest expenses? That's this chart. U.S. government now spends as much on debt service interest payments as it does on defense spending.
So this adds another element to the previous chart in that this is not just the deficit or the debt. This is actually the cost of paying interest on that debt. So the black line here is the net interest. And the huge spike up till current level, that's obviously purely a function of the fact that interest rates went up quite a bit after all the pandemic stimulus created a good amount of inflation, and they've yet to meaningfully come down to prior year levels, which anyone who follows politics or financial news, this very much has to do with why the administration is putting increasing pressure on the Federal Reserve to lower interest rates.
Yeah, and moving on to our next chart, this takes a look at consumer spending in the U.S. What's been dominating it. This is June data, and I don't know if it's a surprise, healthcare has dominated the most recent month of consumer spending.
Yeah, this has become a bit of a trend, of late, where call it discretionary items that people might want to spend on, be it motor vehicles and parts, be it recreation services, which have decreased. You see at the bottom of this chart, you have healthcare, you have gasoline, and you have financial services and insurance, which are atop the list. So although people are spending more on those things, I don't know if one could make the argument that those are items that people are choosing or wanting to spend more on. I just think that those are, supply constrained or specific markets that are frankly expensive as an American.
Moving on to our next big picture chart and our last one. This takes a look at the most recent one measure of inflation for the month of June, and it's still above the Federal Reserve's target of 2%.
Yeah, so the Fed is, in a bit of a position in that recent data, which we'll mention a bit later on, shows the labor market is on the margin starting to weaken. But at the same time, due in large part to the previous graphic, there are certain areas of the economic mix within the U.S. that are keeping inflation pretty notably above for some time what has historically been a 2% target for the Federal Reserve. So that makes it where, from a labor market standpoint, they might want to lower interest rates, but from an inflation standpoint, they are constrained.
To be determined, right? We're recording this on Friday, and we had jobs numbers this morning that disappointed, and now, expectations of the Fed may cut in September. So again, to be determined. But as Chairman Powell has consistently said, the big unknown is what's inflation as it relates to tariffs, because those we did our last video, we talked about how the increase in tariff receipts by the United States, that money's gonna come from somewhere. It's gonna be passed through to somewhere. What does it do to inflation? We'll see. Moving on to domestic equities, the stock market. This first chart looks at the S&P 500, the traditional benchmark. It looks at the equal weight S&P 500, and then the Magnificent Seven, and it looks at the last 3 months of returns. And the big fancy word for this is dispersion.
Dispersion it is. So as you can see here, the biggest of big companies have dramatically outperformed of late, and pretty much all other companies expressed by the equal weight S&P 500 have very much underperformed. And this has kind of been a theme in that we've yet to really see the type of sustained up move in the stock market where all companies are participating to the same degree. So we'll see how this manifests, but this is an interesting chart to keep in mind, in that there's been just a few companies that have outperformed and all the rest have relatively underperformed.
Which that is similar to 2023, and that in of itself doesn't mean that the market's going to go down, because we saw that in 2023, right? And it's just a nuance of the market, the underbelly of the market that I guess most people probably are not aware of, but it's a big deal right now. Sticking with this, going back to our previous chart, despite the bounce in, the other indices were up, just not as much as those Magnificent Seven, those biggest of big tech companies. But small caps have continued to go down relative to those big companies.
Yeah, this is a chart that we show often across different mediums and presentations, but this is basically the small cap Russell 2000 relative to the S&P 500 going back a few years now. And as you can see, there are moments in time where small caps Russell 2000 will start to outperform. That is, the line goes up. But interesting about the most recent rally from the lows earlier this year, small caps have continued to weaken relative to the mega cap companies. So this most recent recovery in the stock market has been disproportionately, on a relative basis, focused on the giant companies that we all know well.
Yeah, for a sustained long-term up move bull market, the small caps at least have to marginally keep up. That doesn't mean the other stuff can't keep going up in a short period, but for a healthy economic expansion, we would have to see some sort of positive movement in small caps. And that may happen, right? It's just hasn't as of yet. This next chart, we talked about this at the end of last year quite a bit, in that the systematic strategies, they're agnostic, completely data driven. They use a lot of leverage on their position. So, what they're doing matters. It moves markets. And what we see here is over the last few months, they went from really underinvested to, back to normal levels of investment.
Right. So the top one here is basically just attempting to aggregate strategies that basically use price signals, so trend or momentum. And the bottom is looking to aggregate strategies that add exposure when volatility is low and stays low, and reduced exposure when volatility is starting to go up. So the net is both categories have added back a lot of stock market exposure. And in order to get the volatility control group, which is again the bottom chart, to continue increasing their exposure, we're going to need further sustained time where volatility is actually low. And at least to start the month of August, it's looking that concept is being challenged.
Yeah, that's a pretty official way of saying it. That VIX going up really quickly, spiking, usually doesn't result in those types of funds adding exposure. But again, it's something to pay attention to, because these are massive market participants that control lots of money. And we've said it before, when they trade, they're not just trading their money, they're also trading with leverage, so it can be substantial, on the amount. This next chart, keeping with, we just looked at institutional strategies and, where they are on their exposures relative to time. This next chart looks at the gross margin balances from the United States regulator, FINRA. And as we see here, they dipped around Liberation Day, obviously market selling off, but they've come way back and then some, to now being really close to all-time highs.
And what's interesting about this is historically this would have been the dominant way to measure, let's call it retail leverage in the stock market. But now not only is this very elevated, but you also have tons of money in levered ETFs, of which that is speculative and is not actually captured.
And you also have the call volume, the single day or really short term, which is again embedded leverage and options. And all those measures are also up. So what we're trying to show here is there's adequate exposure from a lot of market participants, whether they're the biggest to big systematic or more retail focused. A lot of folks are fully exposed.
All in.
Yeah, all in by multiple measures of looking at that data. Moving on to our last chart relating to domestic equities is just seasonality. Looking at history, how does the S&P 500, the broad measure of U.S. equities, how does it perform in different months? And as we talked about in our last video, that in last several, we were coming into a pretty seasonably positive time of year. And, what we're highlighting here is, based on history, that trend is about to change a little bit.
And it's important to just kind of reiterate, in and of itself, this is probably less relevant because, again, this is averaging years over many, many, many years. But when you combine this with the aforementioned graphics that show exposures are much higher in the stock market than they were a few months ago, this perhaps becomes maybe a bit more relevant. So it's like we like to say, when you add two things together, as far as these types of charts or inputs, it can often mean more than looking at any of them individually.
Yeah, because the old adage, looking at seasonality alone, the old adage is sell in May and go away, and that didn't work out too well, right? So May ended up being an unbelievable month. So to Justin's point, you can't just look at one data point and say this is it. It's blending different data points and trying to make a determination. So moving on to non-U.S. equities. This first chart we look at, a U.S. dollar. Again, everybody calling for the demise. Lots of people betting against it, betting on it going down further. That wasn't the case in July.
Nope, the dollar had a bit of a bounce back. So again, this comes after several months of declining. And when we talk about the dollar here, we're referencing what is the Bloomberg Dollar Index. So that's going to be putting it up against, the euro, the yen, etc. But also, it's kind of a broad-based measure. So what we've seen is the dollar has kind of clawed back some losses versus pretty much any and all foreign currency.
Yeah, and this puts pressure on the international areas of the market that have done really well this year, right? The dollar, the direction of the dollar just acts as a natural little bit of a tailwind or a headwind. And obviously, if you were to look at international equity performance for the month of July, it lagged the United States. A big driving force of it is because of the dollar. So next chart, again, interesting, very fringe, but this looks at the amount of dollars that are buying German equities, and you see a pretty sustained down move over the last 4+ years, and then all of a sudden, whoop, starting to move the other direction.
Yeah, and a lot of this obviously came in with Germany announcing they were going to be much more aggressive in terms of fiscal stimulus, and then it is very much connected to the fact that the dollar had started to weaken for several consecutive months. So this is really kind of driven by several different things, but the big picture takeaway is, regardless of anything else, money has been going into U.S. stocks substantially for several years, and up until recently, it's been coming out of European stocks, of which Germany is the biggest market economy there.
Yeah, to be determined. This next one takes a look at an ADR, American Depository Receipt. It's foreign shares trading in the United States exchange, and this particular one looks at Taiwan Semiconductors. What do you have to say about this, Justin?
So you could say that in some sense, this is similar to the prior chart on margin debt, in that this can represent what is risk appetite amongst US-based investors. So as this line goes up, it just simply means that the same shares of TSMC traded in the US are trading at a premium versus the exact same shares listed in Taiwan. And why might that be? It would be that US investors are piling into Taiwan Semi, which, has the narrative of semiconductor, AI, etc. behind it.
And you had the risk before of the China-Taiwan geopolitical kind of deal going on, and that's for the most part been pushed under the rug. So some fears come off, and some money's been chasing this dominant theme in investing of artificial intelligence semiconductors. And so to Justin's point, it's trading at the highest premium relative to the shares that trade in actual in Taiwan. Moving on to interest rates and fixed income. This first chart looks at the 2-year U.S. Treasury, which most closely trades with Federal Reserve policy.
Yep. So again, we're filming this August 1st. Today we had the monthly employment data come out weaker than expected. And as you can see here in the chart, that has prompted the 2-year yield to have a pretty significant one-day drop, at least on a historical basis. Going back several years, there's not been many days that have seen 2-year yields drop by this degree.
And why is that? It's because market participants really quickly are adjusting their expectations on when the Fed's going to cut next, and the probability between the beginning of this week through the Federal Reserve conference and interest rate decision to now has been very volatile. So there are many people pricing in a Fed rate cut at their next meeting in September, and again, the 2-year oftentimes closely tracks what expected Fed policy is going to do. Next chart relating to interest rate has to do with looking at 10-year, kind of the benchmark in the U.S. Treasury market. It's often mortgage rates are determined or driven by the 10-year. Often lending rates are determined by longer-term lending rates are determined to businesses are determined by the 10-year. So lots of people pay attention to it. And what we see here is 10-year yields have kind of stayed range bound at the upper end of where they've been.
So in this chart, you've got the U.S. dollar index, which is the blue line. You've got the U.S. government 10-year bond yield, which is the yellow line. And typically what we've seen is when yields are going up, the dollar is strong. And the reason for that is there's higher yields in the U.S. and that attracts capital into the U.S., which strengthens the dollar. What we've seen since Liberation Day that is highlighted on the far right of the chart is the dollar has dropped notably, yet interest rates, 10-year interest rates in the U.S. have stayed elevated. And, there's several reasons that people would explain that. It could be the deficit, it could be, several different things. But nonetheless, that divergence on what is seen here, a very close correlation, is something that we've definitely got our eye on, in the sense of, is it broken forever, the correlation, or is either the dollar low or interest rates high relative to one another? So as everything, we shall see.
To be determined. But yeah, there's lots of cross currents going on, and eventually they'll be worked out. But there's these periods of time where historical charts data doesn't line up. And, is it, to Justin's point, is it broken forever, or will it work its way out? And if it works its way back towards the mean, the historical average, which one moves? Is it yields down, dollar up, or a little bit of both? And to be determined. Last section, let's talk about commodities. And this, oil dominates commodities. So we always talk about oil. There's, the impact of oil it has on all the other asset markets is pretty robust. So this has to do with expectations for the supply of oil, what's available to the entire globe. That's what these charts have to show.
One rule of thumb in the oil market is that supply is often relatively easy to quantify or predict, versus demand is very much sentiment driven. So if, collectively the market is more or less optimistic about economic growth in the future, that would be the demand function of oil. This is just simply showing that analysis indicates, and this is from the IEA and the EIA, which are very reputable bodies that study oil supply. The expectation is that output is going to go up dramatically towards the second half of this year and into next year. And whether that be coming from U.S. production or OPEC increasing supply, or big producing markets like Brazil now pushing more oil exports onto the global market. Those things are all coming together to create a pretty significant supply overhang.
Which is great for prices, right? When there's more supply and demand stays static, prices tend to come down. I did pay attention in that Economics 101 lecture. So again, we'll see. But if the economy is going to grow, then those supplies shouldn't be as robust, in the traditional relationship standpoint. So again, we'll continue to monitor that. This next chart looks at, like Justin mentioned, the U.S. export, U.S. energy, and what this shows is a pretty remarkable, which we've known the U.S. is exporting a lot of energy, more so than at any time in the past.
Yeah, it's just been it's a remarkable chart, and there's a lot of good analysis out there that would credit the recent strength of the dollar for the past several years, at least in large part due to the fact that the U.S. is now an energy exporter, and thus they're receiving global capital, to buy those energy exports. So Whether or not this continues to accelerate, I think is a different conversation. But nonetheless, the U.S. is now participating in supplying oil to the world, and there's many different knock-on effects from that.
And final chart. I mean, this is like we're ending on satire. Like this is a chart of the price of copper, one of the most important industrial metals in the world, used in so many different applications. And you think it's a big, you think it's some fringe cryptocurrency. No, this is copper.
Yeah, and I think it's good to end on this chart because this is a very important thing that we want to kind of reiterate to everyone that we feel is maybe being missed. People often justify a market moving higher as if the market is giving some sort of fundamental signal. And copper is very much one of those markets where when copper goes up historically and even today, people tend to say things like the market is showing that there's rising global demand or increasing global economic activity. You hear the adage, Dr. Copper. What this chart basically shows is that in modern markets, every single market is exposed to speculation to an extreme degree. And within that speculation, you have these speculative flows drive markets higher for a period of time, but it's often what is the analog? The escalator up and the jump out the window down.
Yeah, waterfall down or jump out of the window.
Waterfall down. That's what you see here, right? I mean, the price of copper dropped over 10% in one day. The global economic reality around copper being used for the economy, for elements of clean energy, the supply narrative, all of that didn't change by 10% in one day. So we just want to reiterate that the commodity markets, especially the domestic and all global stock markets, pretty much any market that you can trade, there's never been more ability to speculate in these markets.
Meaning trade it.
It just
not
means
not copper isn't just moving based on supply and demand of industrial uses.
Right. Yes. So be wary of looking at the price of anything and assuming that it's giving you a clear read through on a fundamental reality. I think is
although it makes for good like attention grabbing TikTok videos or something, but yeah, that's never what we're gonna do.
You're on copper TikTok.
Yeah, there we go. Like get people click happy. But that's it for this chart overload. We really appreciate you spending some time with us. Hope you learned something. Again, we're Sollinda Capital Management, Sollinda.com, SOLLINDA.com. Advisors, check out SollindaWealth.com specifically for our advisor partners. Follow us on YouTube. Justin and I are both on LinkedIn. If you have any questions, you want to, have a little civil discourse on something we talked about. We love talking markets. We get to do this every day. It's a passion for us, and we reserve the right to be wrong, But anyways, you can email us at info@sollinda.com, info@SOLLINDA.com. We hope everyone has a great week. Thanks.